Hey, welcome back everyone. It is time for another red hot cover call video. Well, that's right. I'm back behind the mic fired up. Today I'm going to actually show you one of my secrets, how I use picking the correct strike price as a secret weapon, kicking ass, knocking it down, where I'm able to put real money in my pocket every single month. And that's what we've been doing here over the past 5-6 years. For all those that have stayed on board, still engaged, still understand that you have to put money on the table, and you're enjoying this video, I want to say thank you. I tip my hat. Now, with that said, a lot of people have disengaged from this stock market and they can't take it. But here's the deal. Bills do not stop. Can you say that with me? Bills do not stop. So we cannot stop. And that's why I keep coming back every single week, trying to show you timely and relevant covered call trades for which ups your game. And if anything, keeps you in the game, keeps you motivated, knowing there's a guy like me on the other side of this mic trying to keep it together, generate real income to pay the bills. Now, we're going to go ahead and talk about one of my secrets. I actually laugh because that's clickbait. I do have a quality add to your game today. How do I pick a great strike price when I'm down on my stock, meaning I bought the stock higher, the stock is now trading considerably lower, I need to generate cash flow. How am I going to pick a strike price, and how do I feel comfortable with that? I'm going to show you the things that I do today, okay? So let's go ahead and get to this. If you've never been to the channel and you like what you're hearing, I want you to subscribe to the channel. It's right there and it's free. And hey, look, if you like this video today, bang the like button. It lets me know you like what I'm doing. Now what we're doing is this, we're going to jump right into this, but before I get to that trade, I want to show you what I sent the members. This week I got an email from a member talking about Disney and how he was going to play Disney. Well, I want to look at Disney from a poor man's covered call perspective. I went to my poor man's covered call initial trade setup, plugged in the numbers, and I'll tell you what, this trade sets up as one I would love to do. Now, I'm not going to get into this too deeply, but I want to remind you all there is a free poor man's covered call tracker with your initial trade setup tab or initial trade setup calculator. It's free, no spam. I do not charge you anything. What I want you to do is go there, go to my website, cptdashboard.com, click free spreadsheets, download your poor man's covered call tracker. And what I want you to do is plug in some numbers in that initial trade setup. We've talked about this before. Your very first setup is the most important. Let's say that again together. Your first trade, your first setup is the most important. And we have to make sure time value is at the minimum. You take on a trade that has a lot of time value, you have to write multiple covered calls to come profitable. We don't want to do that. We want to be profitable very first trade. I sent this out to the member saying, hey, look, I love this Disney trade. Disney has literally fell almost 50% since 2020. And now there could be value. Now, understand, and I tell this to the members all the time, where Disney is at. It's standing in the middle of the inflation fire pit that's happening. They get 50% of their profits from all their theme parks, and here's the deal. It is expensive. And for those that travel in, it's even more expensive considering the airfare and hotels. So Disney is going to have a problem. Now, with that said, it has fallen off. It has fallen off where there might be value. Now, at the end of the day, if they're growing their online business, well, Wall Street's going to give them a pass because they realize that this inflation that we're going through, it too will pass. But Disney has to keep growing that online business. Okay, that is the inflationary hedge for them. If they can get traction there, that's a great long-term perspective for Disney. Wall Street will run them up. Now, what I did was this. I said to the members, look, you go to the poor man's covered call initial trade setup. Now, what I did was this. When Disney was trading at 92.62, I went ahead and plugged in that 96 delta, right? That 96 delta deep in the money strike. We still went with that January 2023. We're going to stick with that expire right now, even though we only have 6 months. With that said, I believe with Disney in the down cycle of its current trading range, look at that time value. It's right there. Notice that if I take on this trade, meaning if I buy the $50 Leaps call option, I'm going to pay $43.85 at the time of this trade. That equals 1.3% time value. or $1.23. So that is the true cost of this trade, okay? When you take the $50 leaps call option price and the $43.85 that I pay, you combine them, what do we have? We have a $1.23 difference, right? So that is your cost of this trade. So how do we make it back? We make it back by writing a covered call that makes sense. And in this case, our very first covered call will pay for the trade. And as you can see, if we picked the 94 strike, and if I believe that Disney is at the bottom of its trading range and it moves higher to 94, look at what we can make, right? We're only investing $4,385. Now, because we have bought the leaps call option, that gives us the ability to write a real covered call as if we spent the full $9,200 to buy 100 shares. So we're literally having control of 100 shares, writing a covered call, and we only spent half. Now, look at that. If our shares are taken away, and of course, by now you should know what that means. We're going to close out this trade by closing the short call option, the short covered call, probably paying more money. But because we bought that 95 Delta Leaps, that means as Disney moves, every dollar our Leaps call option moves, 96 cents of that dollar move. So we're going to make effectively 11.62%. Now, if our shares are not taken and we end up keeping the entire premium, keeping this trade alive, that would be 8.6% in 31 days. Now, this is a trade that I love to show the members because we can get value here largely because we only spent half the money. And what I like to do now in my poor man's cover call trades is I think of it, it's a mindset. I was going to spend $9,200 to buy 100 shares. I only spent $4,300. So if this trade goes against me, I can dollar cost down on my Leaps call option. And now I can write 2 contracts, doubling the profits every month until, and I hope, the trade comes clean. Now, that's just a little bit of what I offer at my membership. 1 free month offer for you at my website. I'd love to welcome you aboard. I had about 5 people sign up just this past week. I'll tell you what, they're sensing that something's happening in this market. Yeah, we're having ups and downs, but at the end of the day, it's trading sideways. And guess what? That is perfect for us premium sellers. Sideways to higher, we just pick up little crumbs, knocking it down, putting real money on the table, paying the bills. That's what John does. Now, let's go ahead and talk about my secret to success, how I pick a strike price when I'm down on my stock purchase. I have to write a covered call and I don't want my shares taken away. I have to pick a strike price I'm comfortable with. So how do I do that? Well, I'm going to show you right now. So again, I want to say thank you for those that have stayed in the game. I'm pulling for you, okay? I'm no different than you. We're all down on our accounts. But at the end of the day, we have to put money on the table. That's the reality of this. And that's why I love you coming back to my YouTube channel, because I show you reality in its face. I'm the man in the mirror showing you that regardless of where we're at, regardless if our stocks are up, down, or indifferent, we have to use them because at the end of the day, I got to put money on the table. I truly hope you're getting that now because you cannot have the retirement you want. You cannot live the good life you want if you don't take on that mindset. Hey, look, if anything, John is a trooper. It does not matter market conditions. I keep staying the course. And I'm absolutely happy you've hung around with me. Like I said, a lot of people leaving the game, and I just don't understand that. If you're going to use a portfolio to generate money in retirement, how are you walking away? I mean, this is absurd. I want to grab them by the shoulders and shake them and say, look, let's get the right mindset here. We have to stay the course. Let's talk about this strike price here. I sent this to the members as well. We're talking about Morgan Stanley. Now, Morgan Stanley has earnings in about 1 week. Now, it's been sitting on the bench for me, and you know the golden rules of cover call writing. We want to avoid earnings, largely because it is the most volatile time for a stock. I've talked to you in the past how I use Nike, and Nike, being a household name, huge global company, would move 10% up or down, and it was a $50 stock. Do the math, man. That thing's moving $5 and $6. It's unbelievable how volatile the earnings season can be. And why we don't want to do this during earnings is simple. You buy the stock at 50, you write the covered call, and you maybe collect 2 to 3%, and the stock falls 10%. You're already in the hole. Let's avoid that moment, buy the stock after the fact, and we move forward. Now we have no black swan moments, no company events. We can now move forward based on that earnings move. Well, here's John. He's got all these stocks on the sidelines, and he's played earnings like a fiddle before. It doesn't matter to me. I'll play it because I'm keeping Morgan Stanley. I'm going to keep Morgan Stanley whether it goes to 58, 68, 78, or 88. 88 coming close to my cost basis. Now, with Morgan Stanley trading at about 76.50, I've got some work to do because my true cost basis on this trade is $91. If you remember, I obtained these shares we're talking about right now through a cash secure put, a 91 strike. Stock's trading at 76.50. So we got to make this work because right now Morgan Stanley's sitting on the bench. It's not doing nothing for me, not generating any income. So we're going to put it in the game. Now, when I put it in the game, I have to understand, I can't pick the 91 strike with the stock trading at 76.50. There's no money in it, and it's not going to pay any bills. I have to pick a strike price now that's closer to 76.50. Now, with earnings coming, if Morgan Stanley hits a home run with earnings, we got trouble. We got trouble because a strike price that pays anything decent around 76.50, well, I'm going to have to probably pick 80. Hell, I might even have to back it down to 79. And you know Morgan Stanley could jump $3, $4, $5 after earnings. I have to play this chill, right? I have to be prepared to manage the trade. There is no setting and forgetting this because if Morgan Stanley hits it, then what's going to happen is this. It goes higher, and you can expect Goldman Sachs and JP Morgan to have great numbers, and the tides will rise. All the financials go higher, and now I'm stuck in a trade where I have to buy it back and I'm losing money. And that didn't put money on the table for that month. And now I'm adding to my cost basis, right? It's not 91 anymore. It could be 92, 93, hell, 94. So now I have to make a decision if I'm going to pick a strike price and play this game. So this is what I showed to members. I said, look, one of the things I love to do is kind of gauge based on looking at the chart where it has moved in the past around earnings. In this case, Morgan Stanley's about a $3 bill. Okay, so I can expect great earnings and everything is going right at the company. We'll probably get a $3 move. Now, that's not rocket science. That's gut. And that's also me taking a peek at how they've done in the past. So I'm going to use that $3 number right off the bat. So we're not even going to look at call options that doesn't include a $3 move. Now, remember when I mentioned that if Morgan Stanley has a good run, then Goldman Sachs and JP Morgan will too. And that's where the entire financial sector will move higher just because. So I'm going to factor in another $2. That's right. I'm going to pick, with Morgan Stanley trading at 77x, I'm going to pick a strike that's about $5 out of the money. Now, fortunately, in this case, it pays over $1. And I've got 2 contracts here. And if you remember, I also have, I believe I have one poor man's covered call, Leap's call option. So I can actually get 3 covered calls rolling on this stock. But we're talking about these 200 shares I own now. So I'm looking at that 82 strike right now. The 82 strike. Now, here's why. This is the key. I'm going to show you on a chart, so don't leave me here because we have something very important to talk about. Most people start to fade when I talk about Delta. Okay, they fade when we talk about Delta because people don't understand Delta. Delta has actually 2 meanings, so it can start to get complex. And when it starts to get complex, people fade and they don't do it. Okay, it's just a reality of this. So what I've done and what I've decided to do is not look at this as Delta. Right? If you want to write a deep out of the money strike, you usually start with the 30 delta and then you work backwards, right? Because the delta represents the chances of the stock getting to your strike price in the time frame. So in this case, the 82 strike actually represents the 30 delta. It actually does, meaning from 77x in the next 31 days, the delta for that strike price, 82, the stock has a 30% chance of getting there. Now, there's a couple reasons I love this strike price. And it goes back to what I told you a couple weeks ago. What I love to do now in my trading is talk about a certain percentage from where the stock's trading from where my strike price is. Let me show you the most recent email I sent to the members where I make this very clear. If you like any of this, 1 free month, man, sign up, be a part of something great. Be a part of something that motivates and inspires you. And if anything, you see all my trades and all this stuff. Been talking about it for years. We have had the membership going for over 2.5 years. I'll tell you what, absolutely love it when new members come on board. I love sending them out all the emails, bringing them up to speed. 1 free month. CPTdashboard.com, click upgraded dashboard. I would love to welcome you aboard. Now, this is not rocket science, as I've said. In fact, this whole thing is not rocket science. I've always told you in the past, you learn 1 trade, you do 2 trades. Next thing you know, 4 or 5 trades. You don't need anybody on YouTube anymore. And that's the reality of it. You will learn this, and quite frankly, you will feel it. I've told you that if you buy in and you start putting money on the table, you'll feel the trade. And every single trade I do, I feel. And I love it. And that's why I'm so passionate about it. Now, here's a little trick I do. This is my secret. This is the big reveal. What I love to do is this. Get rid of that whole delta idea. Let's forget about that. I think of a stock moving higher. Okay, I'm always positive. I'm always half cup full. So right now, Morgan Stanley's trading for 77x. I'm not thinking that it's going to fall to 73x. I think it's going to move to 83x. So I'm always half cup full with my covered call rights. So with that said, the 30 delta is typically where I go to start my research when I have bought a stock much higher, the stock's trading much lower, and now I have to dance. I have to use strike prices that fall under my stock purchase price. So we're dancing because if the stock gets above my strike price, they're going to take my shares cheaper than what I paid. I'm going to lose money. I call it dancing. We're dancing. What I've learned over the years is this. A stock will move without any major announcements. Right? Without any major announcements, it'll move about 3 to 4% in a 30-day window. Whether it's going to go up or down, it'll move 3 to 4%. Now, again, we're talking about the big S&P type companies here. We're not talking about the high flyer that literally will move 11% in a day. We're talking the Morgan Stanleys, the JP Morgans. We're talking Bristol Myers and Merck. It's going to trade in the next 31 days, 3 to 4% up and down. So I'm going to use a 4% number. Okay. This gets rid of the delta part of all of this. I don't have to search a delta. I don't have to pick and choose a delta. I just like that 4% number. And if 4% represents a premium I want to get paid, then I'm going to do it. Now, if it's under 4%, so let me explain this. Stock is trading at 77x, right? I'm in at 87x. Well, if I'm going to pick a strike price where I'm going to dance or manage this trade, if it moves, what I'm going to do is pick a 4% higher than where the stock's trading because at least I have the 4% higher move. Okay, so what happens here is this. Let's just role play for a second. Say, for example, Morgan Stanley is having a great month and it's moving 4%. Say I get paid $1 for a strike price that is 4% out of the money. Let's use the 82 strike as an example. Stock trading at 76, I pick the 82 strike. Morgan Stanley starts to move towards 82. Now remember, I gave myself a 4% cushion. Now that 4% cushion for John represents a cushion for which I can manage the trade. So as it's moving, right, as it's moving and it's moving higher, our covered call premium, remember I got paid $1, because it's around the 30 delta is going to move 30 cents per $1 move, right? Now, as the stock's moving towards 82, I'm starting to feel a little nervous here because this could go above 82. But here's what I'm hoping for. In this 30 days, with no news, no ex-dividend date, nothing, it'll get up to that 4%. And now Wall Street's going to start to take profits. And what they'll do, if anything, they'll stop buying. Okay, a 4% move on a big S&P type company like 3M, JP Morgan, Morgan Stanley, that's a big move in a 31-day period. So now I'm hoping that 4% cushion gives me the ability to have it go towards the strike price and then peel off. Okay, remember, Remember what happens as we get close. As we get close to expiration, time decay happens. Here's two scenarios. The stock is under 82. Now remember, my $1 will start to erode, and it'll erode quickly in the final week. If it's not trading above 82, it's going to erode to maybe 5 to 10 cents. Now I'll take 90% of that profit any day of the week, buy it back. Now the stock's trading near 82. We can roll it forward for another credit. Now that's my thinking if the stock's trading under 82. Now let's talk about if it's trading over 82. Likelihood is this. If we didn't have a major moment, the stock market's not blowing up, chances are it's creeping over the 82 strike. Now it's over 82, so I'm going to have my shares taken away. I have to manage this trade if I don't want my shares taken. What I'm going to do is this. As time value starts to compress, right? That time value is compressing and we're over 82. We're only going to have intrinsic value or real money in the option. So say the stock is trading at $82.05. $82.05. We're in the last week of trading. That option could be worth the 5 cents because it's trading $82.05. So the option is always going to have 5 cents of intrinsic value in it with a little time value. And in this case, it'll probably have about 2 to 3 cents of time value because it's above the strike price. It's going to cost me 8 cents to buy this back. I got paid $1 and I'm going to pay 8 cents to buy it back. This is where that 4% cushion came in. Because at 77X, had I picked the 78, the 79, the 80, now we're talking more money to buy this back. So let's step back for a second. Say I picked the 80 strike. The stock's trading at $82.05. I only got paid $1. Now I'm going to have to buy this back for $2.05. Do you see how I've immediately added to my cost basis? Now I'm going to have to buy it back because my cost basis for the shares is at 87. So this is why I love the 4% cushion. And in this case, it actually turns out that this is going to be greater than 4%. Let's go to the charts. I'm going to show you where the stock's trading and why I picked this strike price. Well, we're going to stay right here. I'm going to take you to my real-time trade write-up for this trade. I'm going to show you on the chart as well how this is going to play out for me. So I sent the members this. I sent the members the 2 emails talking about this, then I actually did it. That's the thing you're going to find with me if you join the membership. We talk about it, and then we do it. We are a membership of action. Very important here, action. I show you, and I do it. At the end of the day, it's the only way we're going to make money, right? Well, in this case, it's a $210 projected cash flow, and I'll pocket that money. I own these shares, and we're going to wheel and deal for about 28 days. Now, you can see that Morgan is just getting peeled off like every other stock is right now. But you could also see a little double bottom here, and we might be basing. And in fact, I've been telling the members this for weeks. I believe the selling is over. Now, we'll have up days and down days, as we always will. Volatility rules the day. But now I think we start to base. The worst news is out. Now Wall Street starts to grab onto things. Jobs numbers, inflation numbers aren't that bad. These are the things Wall Street will start grabbing onto, and they'll start pulling up. They'll start pulling the rope up, and they're going to find themselves moving higher. I actually anticipate a nice little dead cat bounce back to at least half of what we lost, but I have no crystal ball, and nobody pays me to make those predictions. What I did was this. I said to the members, we're going to go ahead and do this trade, and I'm underwater. So I have to manage this trade, right? So in this case, Morgan Stanley does have earnings. I'm going to make sure that I pick a strike price for which I'm hoping I won't be challenged. The 82 strike is the one I want, but in this email, I posted this picture. Let me show you what I said. And of course, you already knew what I said because we just talked about it. Look at how Morgan Stanley has been trading recently. And this is why I picked the 82 strike. I actually think that it can retest this resistance. See that line there? That line is resistance. And also notice that it hasn't broken resistance for much. As it keeps going higher, this resistance line is going to become very bankable. I actually believe it's bankable now. I think if Morgan Stanley breaks through that line, it could substantially go higher. Well, I'm not worried about that. I'm worried about making sure I keep my shares. So using the 82 strike, it represents 6.7% from where it's currently trading. So that's a check mark for John. Also, the 82 strike is the 30 delta. That's another check mark. Always love to use that out of the money 30 delta strike. And of course, if there is a rally in Morgan Stanley, I feel like I can manage the trade. It's not going to spike off the table. So as it goes higher, as I explained where the stock's at expiration, either under 82 or over 82, that would be very optimal here. I would have no problem with Morgan Stanley getting over 82 as long as I could buy it back and not add to this trade. Now, because I'm down so much, I'm going to have to buy it back and I'm going to have to add to the trade. But by using this extra 4% as a cushion, I feel like I get an opportunity to manage the trade. Now again, I am going to say this again. We're using large S&P type companies here. Companies that typically move 3 to 4% in a given month. And when they make those kind of moves, Wall Street likes to peel off some profits. They know that these stocks will pay 3 to 4 to 5% in dividends. So for them to make a 3% move, a 4% move in 30 days is quite busy. So I'm hoping I can play that 3 to 4% rally. Now, that is something that I do in real life. And I have had wonderful success at it. Now, whether you have success or not, you got to learn this and you got to have a feel. Right? In those emails, I don't know if you noticed, but in those emails, I said, look, this is not rocket science and it is a feel. There's no book you can open up and it's going to tell you exactly how to handle this trade. There's just not. Okay, it's real world. We have to deal in the real world. Now, how this trade plays out, I don't know. But I'll tell you what, we won't have my shares taken away because I have the confidence to manage the trade. And that's what I hope you learn from all of my videos here. Getting the confidence that you can do it. You can do it because I was a guy just like you 5 and 6 years ago when my mentor and best friend Jerry took my hand, showed me the way, and now I absolutely put money on the table paying the bills. Now look, if you like the video, bang the like button. Absolutely fires me up when I see all you cats hitting that like button, man. Just tells me you like what I'm doing. And I come back. I come back every single week because I know there's somebody out there. I don't know who you are, but I know one thing. I know I've affected your life, whether good, bad, or indifferent, but you keep coming back. And when you do that, it inspires and motivates me to show you how I'm having success in this stock market that's kicking everybody down. Hey, look, it's a mindset, and I've told you this from the jump. If you don't have the mindset, you will not be successful. And hey, look, one free month, I'd love to welcome you aboard. I will email you today. Be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.